Welcome to Sifter Fund's quarterly review. It was an interesting quarter again, however disappointing for the investors. All in all, we feel quite optimistic about the Sifter company's future prospects. The quarter began with a strong rally in January. Due to declines in February and March, we ended the quarter down by 7.9%. If we take a longer-term perspective, for example, by looking at the 5-year performance graph, we can put the early year decline into context. Drops of around 10% happen almost every year, and being able to endure them is simply part of equity investing. However, the decline in early 25 felt more uncomfortable than usual, largely due to the growing uncertainty in the global economy. We keep hearing and reading the stories in the media about tariffs imposed by the US and various other demands and liberation days. It naturally darkens the investors' moods. If we dig a bit deeper beyond the media stories, we can draw maybe different conclusions about the actual situation. We'll come back to this in this review. All in all, the Sifter company's earnings and outlooks remained quite strong throughout the quarter. What thoughts about the situation, Olli, come to your mind?
Yeah, I think that there were three major factors that impacted Sifter Fund's value in this quarter. So the first is economic uncertainty, the other is investor behavior, and third is just foreign exchange rates. So first of all, this economic uncertainty, which you mentioned, obviously has an impact on economic activity. At least it may postpone some corporate investments, but the long-term impact of that is it's too early to estimate at this point. The second is investor behavior. So this economic uncertainty just does impact also that. So investors are maybe now focusing less on long-term earnings potentials and more focusing on short-term earnings and essentially trying to find kind of affordable companies relative when you compare their earnings, their current earnings to their current share price. And that kind of a dynamic is just not ideal for a equity fund like Sifter Fund, where we try to find quality companies. So essentially companies that have this predictable earnings growth trajectory ahead of them. And those kind of companies just, they are never among the cheapest in the market. So this dynamic was kind of against us in this quarter.
Right.
So, and the third factor was the foreign exchange rate. So the US dollar depreciated by about 4% against the euro at the beginning of the year. And since a little bit over half of the portfolio's assets are invested in US dollar denominated assets, the euro denominated fund's value did drop by about 2% due to that foreign exchange fluctuation there.
Right. And it's good to remind ourselves that in previous years, those have been benefit to us.
Yes.
These currency exchanges and changes. So in turbulent times like these, it's really important to focus on the things what we can impact. And that's the business earnings and of course choosing the companies with predictable earnings. So let's start off with the top performers of this quarter and let's try to dig deeper into the short-term and long-term business opportunities for these companies. So we had 4 top performers in this quarter being the Deutsche Börse, Safran, Johnson & Johnson and Tomra Systems. And by the way, except Johnson & Johnson, all are European companies, which is interesting. Right. So Deutsche Börse, for example, it typically performs quite well in the down market. So why is that?
Yeah, they tend to benefit when the stock market volatility increases because that volatility makes investors kind of seek protection against big risks, and they do that by trading these derivatives. And well, essentially, Deutsche Börse earns more revenue when the trading activity in its kind of marketplace increases.
Right.
So that's the reason there.
It's also a beautiful company since it's growing its earnings roughly high single digit, almost 10% per year, yes. which makes it a good business as well, not only a defensive stock.
Yes, that's right. That's right.
Then we have Safran, which is a French aircraft engine manufacturing company, and by the way, the largest holding in the Sifter fund. It has done extremely well in the previous year and this quarter, so isn't it?
Yes, they are doing exceptionally well. So the 2024 results were above expectations, and the company also raised its guidance for this year. And there were two key reasons behind that. So the flight traffic is close to record levels again, and there's also a lot of Safran engines that are due for some significant maintenance fairly soon. There was only some issues with the production of the newer engines, some quality issues with kind of these turbine blades supplied by some subcontractor, but that essentially just kind of slowed engine production. And in December, apparently those issues were resolved, so production continues now at a normal pace. And yeah, it is the largest position in the sector.
And we like the predictability very much.
Yeah. Predictability is nice, and it's partly based on their competitive moat, which essentially is based on the long service contracts that they have and the substantial installed base of engines. The valuation is still, in our view, acceptable. So a lot of good things going on.
Right. Well, then we have Johnson & Johnson, which is a pharmaceutical giant from US, and it's a kind of like a defensive stock, so it should perform quite okay in down markets. And let's not dig into the Johnson & Johnson deeper today. However, we could look at the Tomra Systems, which is one of our newest investments since 2024 January. We invested in Tomra. What might be the reason for a good business and stock price performance last year and especially this quarter?
Yeah, all of the three main businesses of Tomra are doing well. So if we look at the largest business, which is about the sale and maintenance of these reverse vending machines, the momentum in terms of how those kind of machines are adopted in Europe, that momentum seems to be accelerating. So there's more interest in those. UK, for example, is planning to implement that kind of a kind of deposit return system for those plastic bottles by 2027. And if we look at the rest of Tomra's businesses, they are also performing better. So there's been some restructuring, which has improved profitability already, and the kind of order trajectory is also heading now in a better direction. So lots of good things going on there as well.
Okay, interesting. So those were the companies impacting positively for the Sifter Fund share price. And then we have the companies which were like largely declining or had a negative impact on the portfolio in the first quarter. There we have a West Pharmaceutical and BE Semiconductor and Disco Corporation from Japan. So if we could start off with the West Pharmaceutical, the share price declined over 30% in the earnings announcement in early spring. Based on our assessment, is West Pharmaceutical now 1/3 of a worse company than it was previously? Or what is our outlook?
Yeah, no, it's not 1/3 worse. Essentially, the guidance that they issued for this year was disappointing, but we think that there's just temporary headwinds there in the background. So our long-term assessment about this company's capability to grow its earnings hasn't really changed.
So how would you assess what were the main reasons for the share price decline then, and the market disappointed so much?
Yeah, it was that guidance for this year, and there were a lot of details there. But really, when we dig deeper into each line there, they all seem to be just temporary headwinds. So one is that the customers are still adjusting their inventory levels, kind of normalizing them after this pandemic era boom, which you can see in their earnings in this picture as well. Just a reminder, by the way, when we show these forward-looking estimates here, these are market consensus estimates. Our estimates are essentially always more conservative than these, but you can see that also the consensus kind of has the view that these headwinds over the long term should be temporary, but obviously the share price doesn't currently quite reflect that very likely outcome. But yeah, So the normalizing of customer inventory, that's one thing. Other temporary factors, well, they seem to have estimated the foreign exchange rate rather conservatively. Already at this point, it looks like they were too conservative there. There were also some one-off payments last year, which are not repeated this year. And also West exited some low-margin contract manufacturing agreements. So obviously that has an impact on revenue this year, but that's just not really their core business anyway, really. So lots of temporary details, but
So how would you summarize our long-term assessment for this company?
Well, for that, it's good to remind the viewers that what West really does. So essentially, they design and manufacture these kind of packaging and delivery systems for various kinds of pharmaceuticals. But what we expect to drive the growth is that the increasing use of biologic drugs, because kind of the storage and delivery systems of those are just more challenging. So that should generate more revenue for West. So starting from 2026, we expect that the strong growth continues again, and we expect about from this point to over the next 5 years, we expect the revenue and operating income to grow at about 5% annual pace.
So if we put it in our value framework, so the end market of West is still growing. We expect it to grow. West has a clear competitive advantages being the dominant market leader there, and other competitive advantages as well. And the third one, the financial position is strong. It's a solid. There shouldn't be any problem with that. Now there's a temporary hiccup, and now we have done something.
Yes.
And before you give the answer, so it's always difficult, as we all know as an investor, that a stock in your portfolio declines by 30% or more. What should we do? Whether we sell the entire position, or we hold it, we do nothing, or we start to increase because we see that there's more value in the company than the current share price really reflects. So what did we do, Olli?
Yeah, we did increase the share of West in our portfolio. So essentially the share price has declined, but the long-term outlook for the company's earnings, in our view, it hasn't changed. So it just has become more attractive company overall. I mean, an investment overall.
Yeah.
So
in the short term, it feels bad, of course, when the share price goes down, and which means that it has a negative impact on your portfolio. But those are also opportunities where you can increase the position in the company you really like. Moving on to the next company, also decliner, BE Semiconductor, Dutch semiconductor company. Share price also went down. So did we receive some news, or what was the main reasons for BE Semiconductor share price decline in the last quarter?
Yeah, well, overall, it's just against expectations. Their order intake didn't really grow, so they kind of still seem to reflect the general trend in the semiconductor manufacturing space, where anything that is not really tied to AI is not really growing that much, is kind of in a cyclical bottom. So it was a disappointment that they still are not kind of turning that direction. Still, we are confident about the long-term outlook of semiconductor manufacturing equipment overall, because the data in the world, the volume of data in the world is growing, and the storage needs for that is growing, and also the desire to kind of more efficiently utilize that data is growing. So these investments should then pick up then sooner or later. They are expected to pick up over the next few years. So, but.
So one could argue that the BE Semiconductor still meets the quality criteria what we have. However, there are more risk involved in little bit more risk involved or uncertainty involved in the short term demand.
Yes. So even though we are optimistic about the general trend in the semiconductor industry, we didn't choose to increase our investments in BE despite this share price drop, because there's some specific uncertainty about this company's longer term prospects. I mean, they are trying to kind of drive the adoption of this newer equipment, which are used for hybrid bonding, a specific technology in the field of semiconductors. And this year, their customers are doing some tests with those equipment, and based on those tests, they can significantly impact the probability that whether BE's technology is going to be more broadly adopted. But there's so much uncertainty now regarding what those tests are going to look like, the results of those tests, that we chose to kind of take this cautious view and still wait for more information to come in. Obviously, when we look at the consensus estimates, it seems that a lot of the other market participants are fairly optimistic about how this is going to turn out, but we kind of still take this cautious view.
If you look at the graph, so earnings are expected to double and triple in the coming years, which is quite an interesting. We are more cautious and conservative when it comes to very high earnings expectations. We decreased the position already in December, but now in the first quarter we hold the position and we didn't do any action. We are still learning more about the company and the future potential. Good, and then we can move on to the third decliner, which is a Japanese semiconductor company, DISCO, which has been quite volatile stock in the recent years. It has really benefited nicely the Sifter fund, but what were the main reasons? Is there less demand for DISCO's products and services because the share price went down this quarter?
Well, overall, the order intake of that company was also kind of muted. There wasn't particularly strong growth expected like next quarter or seen in this quarter. So in that sense, it kind of reflects the broader semiconductor equipment manufacturing industry. But what was really disappointing was that those AI-related orders, which you would expect to be growing, were actually guided to be kind of flat this year. So no growth, not much decline relative to previous year. And that's kind of in contrast to the earlier trend. Last year was the strongest growth driver of DISCO, and really the general impression is that generally investments in AI-related equipment are growing. So what's behind this development? Well, DISCO themselves kind of gave the impression that fundamentally nothing has changed. Their position in that niche hasn't changed, and they actually continue to invest in manufacturing capacity themselves.
Right.
So it seems that it's really just the customers kind of taking a bit of a pause in investments for this year. And it's possible because DISCO is mainly exposed in the field of AI chip manufacturing, mainly exposed to the high bandwidth memory that they use in those kind of chips, specifically in data centers. So investments in that part of AI chips might really have kind of cycles that are in different sync. The production capacity of high bandwidth memory actually probably tripled last year, so it wouldn't be surprising that this would be kind of a slower year.
Yeah.
So
if you look at the market consensus for the earnings, so they are really optimistic, and we are once again a bit more conservative, but we can also see that the demand for the revenue and earnings in the coming years. And what did we do with the DISCO share price?
I just forgot to mention that this AI-related demand really should be only about 10 to 20% of DISCO's revenue. So we're really talking about a kind of a minor share of the business.
Okay.
Although quickly growing, but or used to be quickly growing, but still kind of a minority of their revenue stream.
I mentioned the volatility of this DISCO share price in recent years, and if you go through the bigger trades we have done for DISCO, so and the most recent one. So
at the very end of this quarter, we chose to increase our position in DISCO because the share price had dropped materially, but still we see that our long-term expectations for this company in terms of earnings are actually not much changed. And this was the first time that we made any kind of a buy or sell decision when it comes to Disco since February 2024. That was the previous time when we traded this. And at that time, we sold a significant chunk of our Disco shares because at that point, the share price really had ran ahead of itself. We did recognize that the company's earnings growth had accelerated and there were kind of sustainable factors behind it. But at that point, the valuation was such that we could find more attractive investment cases in our portfolio. But now, with the current valuation, this is now again a company that we feel comfortable to adding a little bit of money there.
So moving to the next topic, which is the geographical and sector allocation of Sifter Fund at the end of this quarter. There's been a lot of discussion in the early year that this rotation, especially geographical rotation, meaning shifting from the US stocks to Europe or even to Japan, is happening. Well, when it comes to Sifter investment strategy, we don't do active adjustment based on these rotations or trends or any other things. Our portfolio is built through bottom-up research, focusing especially on the business earnings and the long-term valuation opportunities. So if you look at the geographical allocation, and we can see that the North America exposure has remained on that same level in the previous years as well. So we have been always a bit underweight compared to world indices where they have roughly 70% US exposure. What is the main reason for being underweight in US compared to, let's say, other indices or peer funds?
Yeah, well, it's just kind of a side product of our bottom-up research process. So this geographical allocation is pretty much like an accidental end result because we really focus on finding good businesses in attractive industries. And this is just what we end up with. So far, it seems that Western Europe has provided more interesting cases than.
And like in US in recent years, it's been really difficult to find attractively valued companies, the quality companies with a reasonable price. And therefore, we have preferred to invest in Europe. And this is the second observation. You can see from the graph that the Western Europe is about 34% of the total portfolio exposure. And Japan is then rest of the, Japan and Taiwan are the rest of the portfolio. Moving to the sector allocations, we also have two interesting observations. The industrial sector is nowadays the biggest sector in the Sifter portfolio. And does it surprise you?
Well, not really in the sense that industrials is a kind of a very broad category for companies. So we have many different kinds of investments there. But then in a way, it also does feel logical because they are kind of these business to business kind of companies. So we feel that those are more predictable than many of the consumer facing, particularly if you think about discretionary spending. So also these industrial companies tend to have a large installed bases which generate a pretty consistent replacement demand and also service revenue. So a lot of good things there.
So just to mention a few names, so Safran, Tomra Systems, and even Atlas Copco, of course, they are part of this industrial sector. Well, the second observation is, of course, the technology. And technology has typically been one of the highest or heaviest sector in the portfolio, but currently it's a bit less than 30%. And of course, that's for the main reason is that the share prices of some of the tech companies have come down. So it also means that the exposure has come down a bit in the Sifter portfolio. What kind of companies we have in the technology sector?
Well, these semiconductor companies are more represented there than one might imagine. So a lot of those IT companies there really are the kind of semiconductor champions. But in addition to those, well, we have companies like Microsoft also, which are more familiar to the general investor.
Yeah. One could argue that from the portfolio point of view, the current Sifter allocation is nicely well positioned for the current market environment, being quite a lot exposed in Europe, a bit less in US, and also having a heavy industrial exposure. It's really interesting to see how it plays out in this year. But what kind of trades we did and changes we did in this quarter?
We first of all we sold Disney. The reasons there were that their streaming business wasn't performing in line with our expectations, and now they are also facing CEO transition again, which could be a significant risk for a kind of diversified and large company like Disney. So we sold those shares and instead invested the money in Cintas. That's an American company whose main business line is uniform rentals. We'll tell the viewers more about that business in a later video. But essentially why we like Cintas more than Disney is that Cintas is more focused and just more predictable in terms of its earnings. So that was the big change in the portfolio. Apart from that, we made smaller adjustments like the West Pharmaceuticals trade and Disco trade that I mentioned.
Right. All right, very good. And then we can move to the final topic and summarize the whole review. And the final topic is about the valuation and earnings potential. As we know, we are now living in a very turbulent world and almost in a bear market. And it feels bad. As an investor in a Sifter fund myself, it feels bad. However, there's a very little silver line in that kind of declining stock market. It is because the earnings expectation has increased a little bit since the year started. And if you could summarize what it means that our earnings expectation, the earnings yield expectation has increased. What is it in a nutshell and what it means?
Yeah, earnings yield, that refers to our in-house formula where which we use to assess the valuation of companies. And essentially, first we look at the company's earnings and make a forecast regarding them 5 years into the future. And then we take that 5th year earnings estimate regarding earnings per share and divide that with the company's current share price, and that gives us the earnings yield. And obviously, the higher the earnings yield, the more attractively valued the company seems. So in the current environment where we have seen some significant adjustments in the share prices while our long-term forecasts are still mostly intact, the valuation has become somewhat more attractive.
Could you explain it in a graph where we have the average earnings yield and the stock price development in the last years?
Yes. So here we can see the share price development of Sifter Fund as a whole, and then we have this line here which shows the average forecasted Sifter earnings yield at different time points, and also the average of those data points over the past 5 years. And we can make 2 observations here. First of all, the earnings yield has remained at a pretty reasonable level, even though the value of Sifter Fund has about doubled over this 5-year period here. So that's observation number 1. And that 2 is that currently the earnings yield expectation is slightly better than the 5-year average. So that's the little change that has happened first quarter.
Coming to your first point, so our aim as a fund manager is to keep the earnings yield very close to the average by doing the changes in the portfolio. If it goes too much down, it means that the portfolio is too highly priced. And of course, it's nice to go very very up in like in the 2020 when the COVID time when the share prices dived. So it means that the earnings yield goes up. So the best thing is to try to keep it very close on the average of. But now we are a little bit above the average, meaning that the share prices have come down and our earnings expectations has remained quite stable. Of course, it is possible that the earnings will deteriorate in the coming years, but based on our conservative expectations on the earnings, we are quite confident that those businesses will do well in a not if not in a short term, at least in a longer term.
Yeah, but obviously we monitor the situation all the time and make adjustments to those long-term earnings forecasts if needed.
Yeah. And of course, we don't know how the stock market will behave in the next week or next quarter or even in this year. And to be honest, nobody knows. We might go down even more, which typically means that our earnings expectations then rises again. And it can be even better place to buy. Well, it can happen also the other way around, that the stock market rebounds after all this uncertainty is absorbed and or even disappears. No one knows, but what we rely on is the businesses and the predictability of the earnings and the competitive advantages of those businesses. And that's the basically only thing what we do in Sifter.
Pretty much.
Well, we thank you once again for being with us today, and please remember that all the information we have provided and all the examples are only for the Sifter fund way of doing and managing the fund. Those are not intended to be investment advice. We wish you a very good springtime. Be smart and stay calm. Thank you.